So as of yesterday's close, gold is up 18.18% this year. Silver's up 18.13%. So they're neck and neck. So we want to see actually silver start outperforming. And maybe yesterday was a signal that it will. It did very well yesterday, of course, silver. So did gold. So let's jump to the dollar index. Well, the dollar index is down 0.5% year to date, so pretty steady, which means that all you need to do for the major currencies is, even though you should check it each one separately, but it means that the gold and silver are still performing really well versus the pound, the euro, the yen, and so on and so forth, right?
A powerful shift may already be unfolding beneath the surface of global markets as gold and silver move in near-perfect synchronization, hinting at a larger monetary transition that many investors may still be underestimating. The latest market action suggests that precious metals are no longer simply reacting to short-term volatility but are gradually asserting leadership over traditional financial assets. According to Mario Innecco, a seasoned precious metals analyst and financial markets professional, the current rally carries characteristics of an early structural repricing rather than a speculative surge, placing gold and silver at the center of investor attention. At the start of the year, both metals have advanced almost equally, with gold rising 18.18% and silver close behind at 18.13%. Such alignment is uncommon during mature rallies, as silver historically begins to outperform once momentum strengthens. Recent trading sessions, however, may signal the beginning of that transition, with silver showing renewed strength alongside gold's decisive move above the psychological $5,000 level and closing near $5,118. Silver's climb toward the mid-$80 range reflects a dual demand dynamic, benefiting both from monetary uncertainty and industrial expectations. The performance indicates that investors are not merely hedging currency weakness but positioning for a broader shift toward tangible assets. The stability of the dollar index, down only modestly year to date, reinforces an important observation. Precious metals are rising not solely because of dollar weakness but against nearly all major currencies. This suggests a wider fiat currency confidence issue rather than a localized monetary fluctuation. Gold and silver have therefore strengthened relative to the pound, euro, and yen, highlighting what appears to be a global repricing of value. In this context, metals are functioning less as commodities and more as alternative monetary anchors. Comparisons across asset classes further emphasize the divergence. Long-term government bond exposure, represented by Treasury tracking funds, has produced modest gains as economic growth slows, yet these returns remain far behind precious metals. Major equity indices tell a similar story. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates.
And I said in the beginning that gold, silver, and the miners are basically where they left off in 2025, which means they're doing really well. And of course, they outperformed the normal stock market investments like S&P and NASDAQ by a country mile last year. And it looks like it's still the same despite the fact that silver is corrected from like a high of 121, gold is corrected from a high of 5,600. So let's get to it then, because what I did at the end of last year, I like sometimes writing on paper, you know. We type so much these days. So I've got a list here of all the end of 2025 data and performance for major assets and currencies and so on and so forth. So let's start with gold. So as of yesterday's close, gold is up 18.18% this year. Silver's up 18.13%. So they're neck and neck. So we want to see actually silver start outperforming, and maybe yesterday was a signal that it will. It did very well yesterday, of course, silver, so did gold. So let's jump to the dollar index. Well, the dollar index is down 0.5% year to date, so pretty steady, which means that All you need to do for the major currencies is, even though you should check it each one separately, but it means that the gold and silver are still performing really well versus the pound, the euro, the yen, and so on and so forth, right? So this is not just a dollar debasement theme, it's a fiat currency debasement theme. I've got TLT, which is a ETF that tracks long-term government treasuries, government bonds, and that's actually up 2.58%. So it's done okay, and I'm not surprised because the economy is kind of slowing down. But as you can see, gold and silver is still way ahead of bonds, and I've said that before. You know, it might be steady being in the government bonds, but you're kind of losing out relative to real money, right? Gold and silver. So now to the big boys, to the major indices in the U.S. The Dow Jones is up 3.25%. So yeah, underperforming just like last year, gold and silver. NASDAQ is actually down about 1%. It's down 0.94% to be exact. And funnily enough, the S&P is up 0.94%. So they've canceled each other out, kind of. I know people don't look at it like that. But the thing about the NASDAQ, as I said earlier, it's the Magnificent Seven and the AI boom that's supposed to be driving it. But it seems to be petering out, that AI boom. And I'm not surprised that I'm not surprised GDP was so anemic in the fourth quarter in the US. So that makes sense. Markets always have a way of forecasting things. Yeah, it's funny the way it works, but that's how it works. Well, what about the miners? Well, the GDX, you'd expect the GDX to be outperforming the bullion market a lot more, but it isn't that much really. GDX is up 23.9%, which is a few percentage points higher than gold and silver. So I think there's still a lot of room in the miners as well. GDXJ is a little better, 24.8. Again, I'd expect them to do a lot better than bullion, gold and silver. So yeah, still a lot of room. And SIL, one of the silver miner ETFs, that's up 29.01%, which is a good performance. And SILJ, that's up 30.61%. I think we've had some really good earnings from like Hecla Mining and First Majestic. Those are good companies, and they should continue to do really well, I think. And also the gold miners.
While the Dow Jones has posted small gains and the S&P 500 remains slightly positive, technology-heavy markets have struggled, reflecting fading enthusiasm surrounding the artificial intelligence boom. Markets often anticipate economic developments before official data confirms them, and subdued equity performance alongside rising metals may indicate growing concerns about future growth momentum. Mining equities have also participated but have not yet delivered the explosive outperformance typically seen during strong bullion cycles. Broad gold miner funds have risen around the mid-20% range, slightly ahead of bullion itself, while silver mining companies have performed even better following strong earnings from producers. Still, the gap between miners and physical metals suggests significant upside potential if capital rotation accelerates. Historically, miners tend to lag early stages of rallies before attracting wider institutional flows. A potentially transformative factor lies in regulatory developments allowing retirement investment managers greater flexibility to allocate capital into alternative assets such as commodities and mining shares. With trillions of dollars sitting within retirement structures, even a small reallocation toward precious metals could dramatically alter supply-demand dynamics. Institutional portfolios remain heavily weighted toward stocks and bonds, meaning metals remain underowned despite strong performance in recent years. Let's get back to the video.
Is that there was an executive order that was signed into law on August 7th by President Trump last year about making it easier for people who manage 401ks, the investment professionals, to invest in alternative investments like commodities, like gold, silver, miners, and other stuff. And this is supposed to be taking effect, this guidance it is, because it's not that you can't invest in these things, but regulatory-wise, it's still kind of not clear. But this executive order could pave the way for like around $12 trillion of assets to move into commodities. Part of it, a fraction of it, even if a fraction moves into it, it could be a huge thing. There's a lot of capital there sitting, looking for alternatives. And I think, as I said, Joe Public, Joe Blogs, the mainstream financial analysts, mainstream fund managers, they're still heavily allocated towards stocks and bonds. They're not really looking at gold, silver, the miners like we are. But I think that could be changing because last year again they missed the boat on gold, silver, and the miners. Yes, the stock market did quite well and bonds were pretty steady, but they missed out on a lot of gains, and I think people are going to start waking up to the hard assets, to gold and silver, and that's why I'm still encouraged for gold and silver, even though the sentiment is still kind of bearish in a way. So I want to look at this post from this guy Adam Lockwood on LinkedIn. He wrote something really interesting about a week ago, and it's about gold allocation, and he's comparing gold allocation in 1980 to today. So I'll go through it. It says a lot of talk about gold at the moment, so let's break down what's happening versus historical allocations to the shiny metal. He says we're still in the very early stages of a structural shift toward gold. Yes, maybe not central bank wise and sovereign wealth fund wise, because they're ahead of the game. They've been buying loads of gold and silver, and I'm hearing from my sources that yesterday they bought a lot of gold and silver as well. And he says not because of hype, not because of a price spike, but because of uncertainty. So yeah, that's why he thinks the uncertainty is going to start driving people towards gold even more. He says the discussion now shouldn't be about where gold is going next week. It should be about why capital is quietly migrating from financial assets to tangible certainty. So, and then he goes on to look at 1980 and today. He says he calls it the big context. So global GDP in 1980 was 2.9 trillion. Now global GDP, he's got a number of 177 trillion. The reason I say that is because according to the data from the IMF, GDP for the world last year was 117 trillion. But on a purchasing power parity basis, world GDP was 209 trillion. So maybe he's taking a number kind of in between there. So let's say it is 150, 170 trillion world GDP. And financial assets today, he has it at 300 trillion. That as well could be a little more, but it's just a comparison that is important, because back in 1980, financial assets outstanding totaled 3 trillion, which is 100 times less than today. That's what he's trying to like show you there, the big discrepancy, big gap. U.S. federal debt, public debt, $1 trillion in 1980. Now we rack that up. The U.S. racks that up every 100 days. That took 204 years to get the first trillion. Today, of course, we're near 40 trillion. So he says we've had 100 times expansion in financial assets, yet gold ownership has collapsed as a portfolio allocation. And he says the allocation that nobody talks about. So in the late 1970s, early 1980s, after inflation burned investors, gold allocations were between 6 and 8%. He says they were common, right? Today, let's see what he's found out. Well, research suggests gold represents roughly 0.5% of global financial assets, 0.5%. So he goes on to say, in a word, record sovereign debt, record deficits, weaponized reserves, geopolitical fragmentation, central banks buying around 25% of annual mine supply, and yet portfolios are barely exposed.
Historical comparisons strengthen this argument. In the late 1970s and early 1980s, gold allocations commonly ranged between 6% and 8% of portfolios following inflation shocks. Today, estimates suggest gold represents roughly 0.5% of global financial assets despite unprecedented debt levels, expanding financial markets, and ongoing geopolitical uncertainty. Meanwhile, central banks continue accumulating significant portions of annual gold production, quietly reinforcing the strategic importance of hard assets while private investors remain relatively underexposed. The broader narrative emerging from these developments is not one of short-term speculation but gradual capital migration. Rising sovereign debt, persistent deficits, and fragmentation within the global financial system are encouraging investors to reconsider the role of tangible stores of value. Gold's steady leadership combined with silver's emerging momentum implies that the metals cycle may still be in its early phases rather than nearing exhaustion. If these trends continue, the next stage may involve wider public participation, stronger mining equity performance, and increasing recognition that metals are outperforming not because markets are collapsing but because monetary conditions are evolving. The persistence of relatively bearish sentiment despite strong price action further supports the idea that the rally has yet to reach widespread enthusiasm, a condition often associated with longer-lasting bull markets. The central uncertainty remains whether institutional capital will begin reallocating quickly enough to accelerate price movements or whether the transition will unfold gradually as confidence in financial assets erodes over time. Could the moment when silver finally decisively outperforms gold mark the point at which mainstream investors realize the precious metals cycle has only just begun? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.